Do you feel like you're paying too much in taxes every year, or have a relationship with your current CPA where you only meet them once or just before tax time? Look, I want you to know that there is another solution to paying less in taxes and keeping more of your money. Valard Advisors is a leading fractional CFO and CPA firm that specializes in advanced tax strategies for founders, athletes, and entrepreneurs. Valard Advisors can help you navigate the complexity of business taxes and ensure that you're paying the least amount in tax possible. But this is far more than tax preparation. This is strategy. This is really getting into the data-driven decisions that your business needs to make in order to develop a long-term strategy that aligns for your business and personal goals. Whether you're looking to minimize tax liability, maximize your deductions, or plan for your financial future, Valard Advisors has the expertise and experience to help you get there. Do not wait until tax season. Work with professionals today. Contact Valard Advisors to schedule a consultation. Those who can take advantage of flexibility will be able to withstand the market long term, because no matter what, every single market goes in cycles. Real estate is no different. And the 4 phases, we're either in an expansion, we're in a peak, we're in a recession, or we're in a recovery. Welcome to Generation Wealth. I'm Candy Valentino, and I've been building businesses and generating wealth before I could legally order a drink. For more than 2 decades, I've built, scaled, acquired, and exited businesses, all while investing in real estate and building financial freedom. Now I want to help you expand your wealth and give you the proven roadmap to implement today. It doesn't matter if you're a part of Generation X, Generation Y, or Gen Z. It is time to join Generation Wealth. Now let's get started. Hey guys, welcome back to another episode of Generation Wealth, your podcast for all things building wealth, from businesses to real estate investing. We are breaking it down every single week, and I'm so glad that you are here with me today. As I want to dive into, obviously, if you've listened to this podcast or you've followed me on social media, you know that I've been investing in real estate for almost 25 years, which is insane to think about. That the very first home that I bought was a foreclosure back in the early, I think it was 2000 or 2001, in place of the Jeep. And if you follow me on social, you know all about that story and how I got addicted to building wealth with real estate. And so I wanted to break down, if you've heard this, right? You've heard that this is what you're supposed to do, and everybody's talking about it. And for some reason, I don't know why, but now all of a sudden it is the shiny thing to talk about on social media, where people who just started recently investing in real estate now have their own funds for you to invest with them. So I just wanted to share a little bit about, and I did an episode on kind of the dark side of real estate investing, but I want to talk to you about why I think real estate is massively valuable rather than just knowing it's something that you should do. I really want you to have the data and the numbers behind it as to why it's such a great investment. And I talk about in the book and on a lot of other content, I talk about the real estate hat trick and how you can get a few distinct benefits from a real estate investment as opposed to other types of investments, whether they're dividend paying stocks, bonds, treasuries, or just your average mutual fund. And so I want to break those down now, because the hat trick is, I always joke that I don't know much about sports, but I do know in hockey that the hat trick is 3 goals. And although there's more than 3 goals with one real estate investment, there are 3 main ones, and then there's 2 ancillary benefits. So I just want to break them down so that while you're hearing more and more people talk about it, I would, number one, caution you to invest in people's funds, because unless you really know the cash on cash return, what the typical payback is on capital, what is their IRR, like what are all of these numbers mean, and what do they mean inside of this particular person's fund? And how long has this person been investing in real estate? Have they actually been through a reset? Were they investing in 2008? Do they understand the cyclical parts of the market? So I would always caution you to be conservative when investing with other people, but it's always good to know why real estate is good so that you can start to educate and learn more and more about it should you want to get into it. So the 3 distinct benefits are appreciation, tax savings, and cash flow. Right. Those are the three main ones. And I'll talk about the ancillary ones here in a minute. But the reason that real estate is a way that you can build more wealth more quickly is because let's say you have $1 million and you can cut this into 10 if you want, whether you have 10,000, 100,000, 1,000, whatever it may be. In order to get into real estate with, let's say, $1 million, you can leverage that $1 million in a very traditional deal of an investment property and get 4 or 5 million in assets, right? In a very traditional deal. Whereas in stocks, unless you're trading on margin because you've been doing this for a long time, which unless you are a seasoned stock trader, I would never recommend anyone to do. But with stocks, you need $1 million to get $1 million in stocks. But the way the banking system in our country is set up, you can leverage that same $1 million to get far more in assets. So that's one quick reminder of why everyone really talks about real estate. And one thing to caution you on as far as these real estate funds, the reason that people have these real estate funds, unless of course there's somebody that has been doing this for 10 or 20 years, and there's only a few that I could actually recommend. Most people are doing this because they're trying to get into this sexy world for some reason of having, $500 million AMU assets under management or $1 billion assets under management, and they don't have enough cash of their own in order to do that, right? So when you're trying to raise 500 million or $1 billion or something, of course, it's easier to go out and crowdsource, if you will, those investments. But just being cautious that typically the person who's benefiting in that isn't the individual investor. It's the person that created the fund. So you always want to make sure that you get the numbers and that they support what your goals are. We talked about the hat trick, but there are really 5 in general of how you can use real estate for wealth. Obviously, the property appreciates, right? Property appreciation. The second is asset leverage, how you can leverage the property for other things. The third is tax advantages and savings, ways that you can reduce your taxable income so that you pay less in taxes, which is really, other than bad debt, is the greatest destroyer of your wealth. Fourth is flexibility, how you can be flexible with the property depending on what you purchased it for and what happens or shifts in the market. And then last is cash flow. So let's look about property appreciation, the first one. According to the U.S. Bureau of Labor and Statistics, pricing for housing are 857% higher in just 2022. That was the last year that it was done versus 1997. So almost 900%. That's property appreciation because it increases in value over time. You have an increase of demand of people wanting to buy houses, which then builds equity inside of that asset. And when we use simple supply and demand principles, which is really the fundamental concept in real estate, the number of properties available for sale and rent, that's our supply. And the demand is the number of people looking to buy or rent. And as more and more generations and humans and people are born, you're always going to have a need for more and more people to buy housing. Now, of course, in every single local market, there's different pricing, different supply and demand, different availability. And so it's always smart to research whatever market you're going to purchase in, whether it's your local market or another market that you just maybe had been researching and that you know is doing really well. You're always going to want to look at these 4 things. What is the square foot price of the house you're looking to or the property you're looking to purchase versus sold comps? What are the area comps in that area? Looking at the sold price of the homes that are similar. And then also current trends. Are there a lot of people moving into the area? Is there a big demand because of some industry, right? There's a lot of areas, towns, and cities that used to do really well. But let's say, for example, they were no longer mining coal or no longer drilling for oil and gas or no longer manufacturing steel or some other thing that they were doing there. And now all of a sudden there's industry leaving and there's not as hot of a job market or reasons that people are moving to that area. Of course, you can have a stale or stagnant market or one that is on decline. When you look on the other side of that, you could be looking at places that people are moving to, college towns, places with amazing weather, places people are retiring to. And those types of markets are now being pushed up because of the demand. So you always want to look at the very specific market, not just the national market, but the local market of what is going on in that specific area. Now, the second part of this, we talked about asset leverage. How can asset leverage help you and build more of a financial future? And it's through leverage. Investing in real estate gives you that ability to invest with less capital. And it also gives you the ability to leverage with other people's money, banks' money. It gives you a little bit more of increased risk because you have to do some more research in the area that you're looking to invest in, but it could potentially give you higher returns. And obviously there's multiple different verticals inside of real estate investing, from flipping to multifamily to commercial to, doing the BRRR method, which is just a fancy term now for something that's happened forever, where you renovate the property, rent it out, and refinance to get your cash back. There are so many ways that you can do that. And there's so many ways that you can find properties, right? Oftentimes we think that we're looking for what's available on the market, but there are so many other ways that you can find properties and not necessarily wait for retail. It could be from the banks, pre-foreclosures, foreclosures, bankruptcies, divorce attorneys, people that have to split assets and have to sell fast. It could be a trust or an estate attorney, people that are trying to sell assets because they don't want their father's house that was up in the mountains now that they're living in the beach. It could be landlords that have long-term holds and just want to retire or want a simpler life. And then, of course, real estate agents, people that maybe have early listings, pocket listings that aren't on the MLS that maybe you can get before they go out on Zillow and on realtor.com. But no matter what you're looking to buy inside of real estate, you always want to be looking at the data and analyzing the numbers. All of your best decisions are going to come from data and numbers, reviewing the comps, understanding if it's a buyer or seller's market, negotiating, understanding what the reno is going to cost, who your contractors are that you're going to work with, what is the post-renovation valuation, making sure that you're working with a bank that can do a cash out refi if you want to go that route. So there's so many different variables. And the more you know, the better return that you can get and the safer you can be inside of a real estate investment. Now, when we look at real estate tax advantages and savings, not only are you going to be doing the core fundamental income savings that we always talk about, because the highest tax that you'll ever pay is on earned income. When you start to do real estate investing, now this isn't flips. If you're flipping or you're doing the BRRR method, that's all active income. But if you're holding a property, if you're doing a multifamily or a commercial property, that is more passive. So it's already going to be on a lower tax basis. But then you get additional deductions and depreciation on top of that, whether it's direct expenses that are related to the home, like your taxes and insurance and interest and maintenance and repairs, or business expenses like marketing the property, having office space or supplies, business equipment, travel and meals, gas and vehicle expenses. Those are additional deductions that you can take. And then on top of that, you get one beautiful thing that really isn't involved in anything else as far as business goes, and that is depreciation, which is a phantom expense. It's a phantom expense because you don't necessarily pay for it. All other deductions, right? If you're going to buy a computer to write off or a car to write off or your gas or your meals, you're paying money out of your pocket to then deduct that 35 or whatever percentage off of whatever your tax basis is that you're paying every year. You're taking that as a deduction, but depreciation doesn't take additional money out of your pocket. So that's why we call it a phantom expense. Depreciation in general just denotes minimal loss in the asset's value as you hold it. And the IRS has rules, whether that is a residential property or commercial or some type of renovation that's in the property as well. But there's also pass-through deduction and cost segregations and so many other things that you can do inside of real estate investing that you can't in other types of asset classes. And then just to take that one step further, there's so many ways to further defer taxes, whether it's through a 1031 exchange, through opportunity zones, through saving on FICA. There are different ways that you can do trusts as well as self-directed IRAs as well. So you can see as these start to stack, there are more and more benefits inside of real estate investing as opposed to these other types of investments or asset classes. The fourth, we talked about flexibility in real estate, right? This could be you bought a property to perhaps do a short-term rental, and all of a sudden the market shifts because there was so much supply and not enough demand. And perhaps you can convert that property into a single family hold where you do a 12-month rent, or maybe you move into that property, or maybe you convert it into student housing or a multifamily, depending if you're able to do that with zoning. But in general, those who can take advantage of flexibility will be able to withstand the market long term, because no matter what, every single market goes in cycles, whether it's business, whether it's the stock market, real estate is no different. And the 4 phases, we're either in an expansion, we're in a peak, we're in a recession, or we're in a recovery. Like all the time, we are going in and out of each one of those cycles. So understanding where we are in the market and what part of the real estate phase that we're in, what cycle we're in, will help you decide on whether or not it's a great time for you to invest in your first property or the next property. And then last, but certainly not least, that's your cash flow, how to maximize that cash flow. Because for buy and hold real estate investors, cash flow is the primary lever that is used to increase your income, whether it's like NOI, right? Net operating income inside of a business, or ROI, return on the investment inside of your real estate investment. Cash flow, having positive cash flow that is income that exceeds your expenses, is what really every real estate investor is after. And the only way to maximize your cash flow is to really understand your costs. What is your purchase cost? What is your loan cost, your maintenance costs, any management costs? Those are all things that you'll want to have a solid handle on in order to understand what your cash flow potential is. And then you can also use a few different real estate ratios that investors use. Generally speaking, these are not a one size fits all. These are just kind of a general, depends on the type of property that you're looking for and the area of the country of which you're purchasing it. But these are things like cap rate, return on investment, cash on cash return, and loan to value ratio. I go into these in detail inside of the book, Wealth Habits. And then I also talk about the 1% and the 50% rule as well. And that wraps up the 5th way. So just remember, inside of real estate investing, you get property appreciation, asset leverage, tax advantages and savings, as well as flexibility. And of course, the holy grail, cash flow. It all goes back to the data and the numbers to support the buying decision, to know exactly what your expenses are going to be and what your potential profit, ROI, and cash flow will be on that property as well. Okay, guys, the more you understand real estate investing, the better decisions that you can make. So keep learning, keep growing, and keep tuning in every single week. I'll see you next time. And don't forget that if you didn't buy a copy yet of Wealth Habits, it is now available on Audible. And thank you so much for all of your support, because we are #1 bestseller, new release in multiple categories. And of course, if you already have a copy of the book and downloaded it and listened to the book, please consider leaving a 5-star review over on Amazon. It would mean the world to me, as well as many other readers that need this information. Okay, guys, that's it for today. We'll see you next time on Generation Wealth.